Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Good morning. Welcome to the BOGART Effect. I've got Misty Garza with me, and we're going to be talking about retirement strategies. Today's talk is actually one of a multi-part series that we're going to be doing where we break down and go into more detail on certain elements of not only the retirement process itself, but we're going to also be talking about ways to review, monitor, and then optimize going forward. So today we're going to focus on withdrawal strategies. My perspective with withdrawal strategies is in order to even be able to go down the road where we're talking about withdrawal strategies, we need to have a financial plan in place. If you haven't gone through the process to build out a financial plan and you're debating any type of life event, whether it be retirement or selling a business or anything of that nature, I really think that you're cutting yourself short. At Bogart Wealth, part of our core competencies is planning. The reason that we do it is it's the epicenter of pretty much every conversation we're having with our clients through the lifespan of our relationship together. And I really do think it's important in order to be able to get into this topic today, you need to have a plan in place. So Misty, thanks for the time this morning and looking forward to having a productive conversation. So why don't, at a high level, talk to us a little bit about what is a withdrawal strategy?
So again, kind of what you mentioned, the core is figuring out the plan and what do we need for withdrawals and kind of what that dollar amount looks like. And so there's various ways to recreate your paycheck, which is really the withdrawal strategy of how to pay the bills in retirement. And there's various income sources that people might come into retirement with. And so it's the idea of figuring out what your goals are, what your income need is, the assets that you currently have, and figuring out what type of withdrawal strategy works for you and your family.
Well, and I want to pull on a couple things that you just mentioned there because I think there's a lot of nuggets just in that statement itself. But the reality of it is it's imperative in order to talk about your withdrawal strategy. The first thing you need to look at is what are the income sources you have. And every household will be a little different here. It might be Social Security income. It might be part-time income from employment. It might be restricted stocks that are vesting out. All of that needs to be factored into this conversation of withdrawal strategies. And then the second thing you talked about is needs. I think of needs come in two different flavors. There's our essential needs and there's our discretionary needs. And this is where when we talk about a household, as they're making this transition, this life event, very seldomly does someone retire and want to all of a sudden live on less, right? And for a lot of our clients, they have multiple phases of their retirement. Typically, right when someone retires, they have a very active phase. They go through what we call the go-go period of time. They're usually healthy. They want to travel. They've got more free time. It's also usually when we see country clubs and golf and tennis and pickleball, right? Like you're very active. And then at some point in there, we start to see a transition over into what we call the slow-go period, and then eventually the no-go period of time. But the reason that we say that is because all of these expense profiling and modeling, it's really important when we come back to have this conversation around the withdrawal strategies themselves. I would also add, and Misty and I were talking a little bit before we did the podcast, but when you talk about withdrawal strategy, or understanding or identifying your needs, I think it's extremely important that a couple collaboratively identifies what the expenses are, because it's not uncommon that a husband and a wife might have a different perspective on what's essential versus non-essential. I know that's certainly the case in my household, where there's certain things that my wife would say are non-negotiables, and I would say, though, that's extremely discretionary. But that's the reality of having a household. And I think it's important to make sure that we're identifying those.
Yeah, and sometimes it's a matter of maybe one person has handled all the finances, and so the other person doesn't even truly know what they're spending. And so going into this next phase of retirement, it's really important to understand what those expenses are And I think the biggest misconception is that when you go into retirement, you're going to spend less. Certainly things are going to fall off that were work related, but obviously as you have more free time to do your hobbies and medical expenses, things like that start to come in at different phases in retirement.
Bingo. Yeah, couldn't have said it better. So one of the questions we get a lot is, what is a safe withdrawal rate? And the reason that I think that it's important to frame this before we get into kind of strategies for handling withdrawals is there is no normal. Every household is extremely different in terms of what is quote unquote safe versus not. And it can be very subjective. Obviously, if someone has an income source, well, that means that their portfolio is not having to be drawn on at certain levels, right? Which that ultimately needs to be factored into what their combined or total outlay is. But general guidance, general rule of thumb is if someone's portfolio is growing at 5.5% and they have a 2.5% inflation rate, so that's a 3% real rate of return, just the difference between those two numbers. If someone is withdrawing at 4%, and the reason I say 4% is because that's the number that's commonly discussed as the safe withdrawal rate, well, that portfolio is going to last for 41 years. So the reason I say that is because if you're 60 retiring and we assume the portfolio is going to last for about 41 years, for most Americans, that's a pretty safe number. But if you're talking about retiring at 40, well, no, that's not really the case. Obviously, I'd love to talk to what you're doing to be able to retire at 40, but the point is that might not be a safe withdrawal rate at that state of life. Now, going down in those numbers, I said 4% the portfolio will last for 41 years. If someone draws at 3%, the portfolio is actually going to last for 99 years. If they draw at 2%, the portfolio is going to last for 167 years, right? So the point is that the less you spend, the bigger the portfolio will continue to grow because of the ratio between your withdrawal rate and what it's accumulating at. Now, if we go the other way, if the portfolio draws at 5%, that portfolio is going to last for about 28 years. 6% is going to last for about 21 years. 7% is going to last for about 17 years. And you get the gist, right? So if someone's retiring, for example, at the age of 75, well, sure, they might be spending more simply because they have projected less years to live, right? I know it sounds kind of morbid, but that's why when we talk about the fluidity of what is a safe withdrawal rate, well, everyone's situation is going to be very, very different dependent upon, again, income sources, age, duration, longevity. Now, I will add, if there's any type of inclination to leave wealth to the next generation, well, that's a great example as to why we need to actually have a discussion around a lower withdrawal rate potentially. And again, each and every one of us is going to be a little different in that regards. So, Misty, why don't we spend a couple minutes talking about different ways of withdrawing off of a portfolio? The most commonly discussed ones are an income-only approach. There's a systematic withdrawal approach, and then there's a bucket approach. Why don't you elaborate a little bit on what is an income-only approach?
Yeah. So an income-only approach, I think, people just assume they're going to live off of whatever income is spun off of their portfolio, simply put. Now, that's probably easier said than done for some people, going back to whatever their income needs are. So if their income needs are a very small percentage, then it can be easier to do income only. If it's a little bit higher, we have to look at different investments to be able to spin off that 4% or 5% or 6% or whatever somebody is looking to need. And sometimes people don't understand the relationship of knowing, if I need a 4%, what does it take to get that level of income? Or they might be chasing income and say, well, this investment's paying me 7%. So why don't I just put my money in this, live off the 7%, and I'll be good for the rest of my life. So there is a component of risk that we'll talk about later to that income. But the idea is your portfolio spends off exactly what you need. Now, obviously, inflation and things like that come into play as well, but really just living off of that, whether it's using a stock portfolio or a bond portfolio.
Misty, I love what you just said there. To do an income-only approach means that your investment strategy is going to be predicated in really one direction, where you're leaning on investments that pay income. That's not necessarily going to be a full representation of, for example, the S&P 500. If anything, the S&P 500 is very growth oriented, so there's not a lot of dividend income as an example. So the point is that an income oriented investor historically is going to be investing in bonds or other types of fixed income vehicles, dividend paying stocks, and that's typically how they're generating that paycheck. But Again, if you're only investing in dividend paying stocks, you're actually precluding yourself from being invested in a large subset of the rest of the market. We're going to have a whole podcast presentation where we talk about risk, identifying risk, and then get into some of the nuances associated with how to manage that. But the point is an income only approach. It sounds very conservative, and it typically is from a preservation of principle, but it does mean that we're only focused on one type of particular strategy and not necessarily always fully diversified in that regards. So the next approach that we talk a lot about is a systematic withdrawal. And typically with a systematic withdrawal approach, it's you just set up your paycheck and you're liquidating assets along the way. Now, the portfolio structure can be determined based upon your risk profile. Most of our households are moderate risk investors, so that would follow, for example, like a 60% equity allocation, 40% fixed income. But we also have clients that are very growth oriented and might be 90, 95% equity oriented, so a lot more stock exposure. But as we're pulling from those strategies, we're having to liquidate things along the way, regardless of where that money is being invested. So we're going to be much more subjected to whatever's going on with the markets.
Yeah, and you do have to be more moderate in that sense because of the markets, right? So the idea of, the markets are not always going to be positive. So it works if you could guarantee the markets are always going to be up. You could do a systematic withdrawal forever and still be successful. But we all know that that's not truly how the markets work. And so there is some of that component of being dependent upon those returns by systematically selling every month or every year.
Yep. And because of that, you're going to have a more material change in the portfolio value along the way, right? You might be having to sell things that are at losses at periods of time, as an example, and that doesn't always sit well with folks, right? So we make sure that we manage that all appropriately, and ultimately are kind of mitigating risk as best we can. But the reality of it is a systematic approach doesn't always factor in the timing element of when someone may or may not need funding. For example. And then the third kind of commonly discussed approach is a bucket approach. Misty, why don't you get into that one for us?
So the bucket approach would kind of maybe encompass all of these, right? It would have a little bit of a systematic approach, might have a little bit of an income approach, but it's really about separating out your assets into different buckets for cash flow purposes. So if we know that we have a pension or Social Security coming in, we already have some income, then we would look at what's the remainder of our income need for the year. So maybe it's the whole amount or a little bit. So we look at what that is, and we'll set aside a couple of years worth in this bucket one that we'll call it. And a lot of bucket one can be determined by what the current market conditions are and what we're able to get into the market. But the idea of bucket one is that we want it to be almost guaranteed. We want it to be very conservative, very little market movement to that bucket, so that as you're selling out and as we're sending you money, there's not going to be any market risk. And your risk profile can determine how much needs to be in that bucket one as well, and kind of what our goals are. So for some people, that bucket could be 1 to 2 years. That bucket could be 3 to 5, right? Yep. Again, it all depends on how much assets you have, what your withdrawal rate is, and what your preferences are. And then you have this middle range bucket as well, kind of your bucket 2, which again, depending on what bucket 1 looks like, could be anywhere from 3 to 7 years worth of cash flow, could be 3 to 10. Again, very, very dependent on the individual's needs. And again, subject a little bit to where the market is, but we still want that bucket to be a little more moderate in nature. We don't want it to be all in the equity piece of the market. We save that for bucket 3. And bucket 3 is typically our 10 plus year bucket out. And the reason why we do that bucket is because we can ride out the market. And you can look through periods of time, and the market always recovers as long as you do safe, sound, nothing crazy investments, and you let it sit and don't get in and out of the market. Those kind of things will get you back to where you need to be. And so the idea with this bucket approach is that as you use bucket 1, you fill it up. So if the market's doing good, you can look and see did bucket 2 or bucket 3 gain some good grounds, and so you can refill that bucket 1. If they didn't, and it was a terrible time in the market, then you know what? We still have some excess money in that bucket 1 to get us through. And then bucket 2 typically shouldn't be moving too much if things really got to a point to where we've had a couple of years of a downturn in the market. Again, the idea really with the bucket approach is one, to not have to sell at losses. And it also helps people from a risk profile to be comfortable with their withdrawals and not make any kind of irrational moves of changing their investment strategy and their risk profile suddenly because their accounts may or may not be down.
Well, and to kind of build off of that in a practical use sense, right? Like we'll have our steady state, like the normal replacement of paycheck, which is what we're trying to get to as quickly as possible after a life event. But the reality of it is other things are going to come up along the way. It might be you're buying a car, or you're going to help a kid buy a house, or college expenses, whatever it is. Those are great examples of where we might adjust the overall allocation, moving positions from either bucket 2 or bucket 3 into that bucket 1. Because the only thing that we can guarantee is that there are particular periods of time when the market goes down. We know that. And as Misty mentioned, the longer you give it, the higher the probability of success. That's why we're willing to take risk with that longer term orientation of money. But if we need that money in a more intermittent period of time, then unquestionably, without a doubt, we need to be in a position to have full visibility as to where the cash flow is coming from and not have to worry about market undulations, volatility, et cetera. All right. This was productive, I think. I guess kind of recapping and talking about withdrawal strategies. First and foremost, we've got to have a plan. And in order to be able to make any of these decisions and conversations, you really need to have an understanding of the timing needs associated with what your withdrawals are going to be. If you've got trips coming up, or you're going to be buying a new home or cars or whatever, all of that needs to get factored in to then build out and understand the timing associated of when you're going to need withdrawals. And then from there, we need to go through an assessment to determine what is your comfort level with risk to build out that appropriate mechanism associated with what that withdrawal strategy needs to look like. And I think that, ultimately this is one where it's a great opportunity to engage with your advisor, make sure that you're holding yourselves accountable on the spending side, and also simultaneously make sure that you're holding them accountable with how they're delivering in terms of performance and rate of return. Anything else to add today, Misty?
No, I would just like people to keep in mind there's no one size fits all when you hear about people talking about withdrawal strategies. Everybody's different. Everybody has different goals. Everybody has different portfolios. And so it's important to just understand what those are, have them be flexible, because as you go through retirement, those goals might change as well. So it's important to understand what those look like and how they fit into your situation.
Awesome. Hey, stay tuned for our next segment on the retirement income strategies and talking a little bit about risk on our next one. Thank you.
Sounds good. Thanks.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.